Expectations are very important because if we don't expect anything, nothing probably is going to happen. But making sure that our expectations are reasonable is critical into keeping our sanity and also in making sure that we don't end up in the long run way short of where we need to be. 70% of investors expected to make at least an 8.7% return on their investments, according to CNBC article that was published on September the 29th, 2016. Even though advisors were telling them that a realistic return was just a little bit under 6%. And Dalbar reports in January of 2015 that actual returns are less than 2.8%. So in this graph, we can see what's expected, what is being advised to be expected, and what is actually happening in the investments. A part of that could be that in 2015, CNN Money ran a story that said 70% of investors lost money over the course of the year. So there were many more losers than there were winners. In fact, this article in CNN Money went on to say that those who really won were those who really just saved more money, not that they actually made more money on their investment. They even went so far in MarketWatch as to map out in early 2016 which part of the countries were losing the most when they were investing. And here's the important thing. If you're in that 70% who's losing money, you need to understand what it is going to take to overcome your losses. An 11% gain is needed to overcome a 10% loss. A 33% gain is needed to overcome a 25% loss. And an 80% gain is needed to overcome a 50% loss, while a 500% gain is needed to overcome a 100% loss. The real cost of investing in mutual funds, according to Forbes, has an expense ratio of 0.9%, a cash drag of 0.83%, transaction cost, which includes fees and service costs, of 1.44%, and taxes of about 1%. Total costs then, depending on if it's taxed or non-taxed, can be anywhere from 3.17 to 4.17. And we look at those as they bounce around on this graph, and then we finally see the total cost realized here. Taxed versus non-taxed. Well, let's look at the 20-year average investor's return. According to Dalbar, the 20-year average return is 2.6%. And over a 30-year period of time, that return actually goes down, not up. Now, what is this average annualized return? It represents small, large, as well as professionally and non-professionally advised investors. And so this is very important for us to have in our knowledge bank so that we can have realistic expectations for the future. Now, I just wanted to throw this up here because so many people say that whole life insurance is such a bad investment. But if we'll look at the annualized returns on a participating whole life insurance product over the same time periods, we can see that the annualized returns are much higher in whole life insurance than the average investor that is investing in the market. In fact, we can go and look at, with the same capital outlay, we can see that using the transaction cost of 1.4% and the average return on 2.6% that we just talked about for 20 years and then 1.87% for the next 10 years, we can see that after 20 years in an investment, you can have $123,000, or if you bought life insurance, it'd be $151,000, almost $152,000. By 30 years, your investment can be expected to earn $184,000 or $306,000 if you put the same capital into a participating life insurance. And much of that has to do with the transaction costs here and the fees, because as those fees are taken off the top of your proceeds, of your earnings, then it's not there to compound again for you, whereas life insurance is always allowing the compounding to go in your favor. So what are we to expect? You expect the market average? Expect to pay the cost. And expect to have less with no death benefit. Jack Bogle, the founder of the Vanguard Mutual Fund, states in his book, Don't Count on It, if the stock market provides an annual return of 7%, we know that the average investor's return will fall short of this by the amount of fees they pay. Those fees amount to about 2.5% annually for the typical investor, so their net return is down 4.5%. Next, taxes will knock off another 1%. And this is the critical part here. $1 grows by $4.60 over 50 years at those kind of rates, whereas $1 grows by $28.50 at 7%. In other words, investors' cumulative returns are less than 17% of the expected market returns. That's an enormous gap, and one that can easily mean the difference between achieving your long-term financial goals or falling far short of them. It all comes down to expectations, but those expectations need to be based on reality, not speculation, not assumptions, not believing that you can get the return that the market has produced over the course of the market history. There are other things to consider, and those expectations need to be adjusted accordingly, or you will end up way short of where you expected.